Pull up any real estate app right now. Go ahead. I'll wait. What do you see? You see homes listed for prices that, just 3 years ago, would have made your jaw hit the floor. You see listings sitting there for 60, 80, even 100 days with no offers. You see price reductions stacked on top of price reductions like a clearance rack at a store that's going out of business. And yet, here's the wild part. Your neighbor still thinks their home is worth what Zillow told them in 2022. This is the disconnect that is quietly reshaping the American real estate market in 2026. And if you are planning to buy, sell, rent, or invest in property this year, you absolutely cannot afford to ignore what's happening beneath the surface. I'm going to break down exactly what is going on, city by city, market by market, and tell you where the real danger is, where the real opportunity is, and most importantly, what moves you should be making right now. Stick with me through this video because the information I'm sharing in the second half could literally save you or make you hundreds of thousands of dollars. Let's get into it. Before we zoom in on specific cities, we need to understand the macro story, because everything happening locally is being driven by forces at the national level. Here's the truth. The US housing market is not one market. It is thousands of micro markets all behaving differently. But what ties them together right now is a shared hangover from one of the most irrational buying frenzies in American history. Between 2020 and 2022, mortgage rates dropped to historic lows. We're talking rates below 3%. Money was essentially free. Buyers flooded the market. Bidding wars erupted. People were waiving inspections, paying $100,000 over asking price, and buying homes sight unseen in cities they had never visited. That era is over. The Federal Reserve raised interest rates aggressively to fight inflation, and mortgage rates shot up to levels we hadn't seen since the early 2000s. Monthly payments on the same home effectively doubled for many buyers. And just like that, demand fell off a cliff. But here's the problem. Sellers didn't get the memo. Many homeowners, especially those sitting on low, locked-in mortgage rates, have refused to list their properties. This created what economists are now calling the lock-in effect. Inventory is still relatively tight in some markets, but buyer demand has cratered. The result? A frozen market where neither buyers nor sellers want to blink first. Now, in 2026, cracks are beginning to form. Job losses in key industries, rising property taxes, skyrocketing insurance costs, and ballooning HOA fees are forcing some sellers to act whether they want to or not. And that, my friends, is where things get very interesting for those paying attention. Let's talk about the cities where the market reality check has been the harshest. These are places where prices ran up the fastest and are now correcting the hardest. Number 1, Austin, Texas. A few years ago, Austin was the hottest real estate market in America. Tech companies were relocating there. Remote workers were flooding in. Property values were doubling. Today, the story has completely reversed. Builders during the boom couldn't construct homes fast enough to meet demand. But they kept building even as demand began to fade. Now Austin has one of the highest inventory levels of any major metro in the country. All that new construction is competing directly with existing homes, and sellers are getting crushed. Data shows that Austin home values have dropped nearly 20% from their pandemic peak, one of the steepest corrections in the nation. For someone who purchased a $700,000 home at the top of the market, that represents roughly $140,000 in lost paper value. Rental investors are feeling it even worse. Rents in Austin have fallen consistently for over a year. If you bought a luxury rental property expecting cash flow, you're likely experiencing negative cash flow right now. The lesson from Austin? When supply and demand get wildly out of balance, the correction is painful, and it doesn't happen overnight. It grinds you down month after month. Number 2, Phoenix, Arizona. Phoenix became the poster child for pandemic migration. People leaving California, Illinois, and New York chose Phoenix for its lower cost of living, no state income tax, and warm weather. But Phoenix has a fundamental weakness that investors overlooked. Land is essentially unlimited in the desert. Unlike cities constrained by mountains or water, Phoenix can keep sprawling outward forever. That means builders can always add more supply, and add more supply they did. The luxury segment in Phoenix has been hit particularly hard. Supply of high-end homes has expanded dramatically since 2022 while demand has softened. Price reductions are common. Days on market have stretched considerably. But there's more than just supply and demand at play here. Insurance premiums in Arizona have jumped significantly due to extreme heat events and wildfire risks in surrounding regions. Property taxes are rising, and the city is facing real long-term questions about water availability, a concern that sophisticated buyers are starting to factor into their purchasing decisions. When a buyer starts worrying about whether their swimming pool will be legal in 10 years, that's a red flag for long-term value. Number 3. Boise, Idaho. Boise became the symbol of the Zoomtown phenomenon, cities that exploded in popularity when remote work became mainstream. People from California, Washington, and Oregon poured in, driving prices to levels that felt absurd for a mid-sized Idaho city. But when companies began calling workers back to the office, the migration slowed. And the buyers who had fueled that boom? They disappeared. Home values in the upper tier of the Boise market have fallen sharply from their peak, among the most severe drops of any market in the entire western United States. Months of supply for higher-priced homes have ballooned well beyond what experts consider a healthy, balanced market. Sellers in Boise are now offering significant concessions just to get deals across the finish line, paying buyer closing costs, buying down interest rates, even including appliances and furniture in the sale. The desperation is real. This is the danger of a market built almost entirely on migration momentum. When the migration stops, the fundamentals that were never really there in the first place get exposed. Number 4. San Francisco, California. San Francisco is a story of structural decay meeting economic reality. The city's dependence on the tech sector made it extraordinarily vulnerable when the industry began its correction. Mass layoffs at major tech companies didn't just affect employment, they destroyed the wealth effect. When your net worth is tied to company stock options and those options lose value, you don't go buy a $3 million condo. Office vacancy rates in downtown San Francisco have hit record highs, and the commercial real estate implosion is dragging residential values down with it. Luxury condos in certain downtown neighborhoods have seen price per square foot revert to levels last seen nearly a decade ago. For investors and homeowners alike, this represents an enormous destruction of wealth. Sellers who need to move are finding a buyer pool that has shrunk dramatically and a pricing environment that is brutally unforgiving. The insurance crisis adds another layer of pain. Major insurers have exited the California market entirely due to wildfire exposure, making it nearly impossible and extraordinarily expensive to insure older, wood-framed homes that make up much of San Francisco's housing stock. No insurance means no mortgage means the buyer pool shrinks to cash-only purchasers who demand steep discounts. Number 5. Miami, Florida. Miami deserves special attention because its problems are unlike anywhere else, and they are almost certainly going to get worse before they get better. Florida's insurance crisis is not a market cycle. It is a structural, long-term problem rooted in climate risk and reinsurance economics. Homeowners in many parts of Miami are now paying insurance premiums that are 3 to 4 times the national average. For condo owners, the situation is even more dire. Following the tragic Surfside building collapse, Florida enacted new legislation requiring condo associations to maintain fully funded reserves. This sounds reasonable, until you realize that many associations are now issuing special assessments to unit owners that run into tens or even hundreds of thousands of dollars per unit. Imagine buying a $900,000 condo in a beautiful beachfront building, then receiving a letter 6 months later informing you that your share of the building's structural repair reserves is $85,000, due within 90 days. This is not hypothetical. It is happening to real people right now, and it is causing a significant sell-off as condo owners try to offload properties that have become financial liabilities. Luxury inventory has surged as a result, but buyers, when they can find affordable insurance at all, are negotiating hard. The market has shifted decisively in favor of buyers who are patient, informed, and financially prepared. Okay, I've spent a lot of time on the bad news. Now, let's talk about what smart money is actually doing in this environment. Because every market cycle creates winners and losers, and the losers are almost always the people who aren't paying attention. Opportunity. 1. The long-term buyer's advantage. If you are planning to live in a home for 7 years or more, many of these crashing markets actually represent real buying opportunities, as long as you buy the right property at the right price. Here's the thing about corrections: they don't last forever. The fundamentals of housing demand in America are strong. Population growth continues. Household formation rates are high. The construction industry has underbuilt for over a decade. When mortgage rates eventually come down, and most economists believe they will over the next few years, a significant wave of buyers who have been sitting on the sidelines will re-enter the market. When that happens, prices in well-located markets with strong employment bases will recover. The buyers who purchase during the fear phase of a correction tend to be the ones who build the most wealth over time. The trick is having the financial resilience to handle the short-term discomfort. Practical takeaway: if you're buying to live in a home long-term, look for properties that have already absorbed a significant correction, 10 to 20% off peak pricing. Negotiate hard, ask for closing cost assistance, get a thorough inspection, and make sure your monthly payment is comfortably within your budget, even if rates stay elevated for another 2 to 3 years. Opportunity. 2. Markets that are actually performing well. Not every city is experiencing a correction. While the headlines focus on the markets that are hurting, there are metros that have shown genuine resilience and even continued appreciation. Markets with strong, diversified job bases and constrained housing supply have held up significantly better than the boom and bust pandemic favorites. Cities like Columbus, Ohio, with its growing healthcare, tech, and finance employment base, have maintained relatively stable values. Indianapolis has shown similar resilience, supported by affordable land costs that allow for price appreciation without the speculative excess. Hartford, Connecticut has quietly become one of the more stable housing markets in the Northeast. What do these cities have in common? They didn't see the insane speculative run-up during the pandemic years. They grew at a measured pace, supported by real economic fundamentals. And now, as the frothy markets correct, these steady performers are looking increasingly attractive to investors seeking yield and stability. Practical takeaway: if you're an investor, stop chasing the cities that are still recovering from boom-era excess. Look at secondary markets with strong employment growth, growing population, reasonable affordability, and low vacancy rates. The risk-adjusted returns in these overlooked markets are often substantially better than anything you'll find in a headline-grabbing city. Opportunity. 3. The negotiating environment has completely flipped. This might be the most important thing I tell you in this entire video. For the first time in years, buyers have real leverage, and most of them don't know how to use it. When a seller has been sitting on a listing for 60 or 90 days, they are emotionally and financially exhausted. Their carrying costs are mounting. Every month that passes without a contract costs them money. They are receptive to negotiation in a way that would have been unthinkable in 2021. This means you can ask for things that used to get laughed out of the room. You can ask the seller to contribute to your closing costs. That's money you would otherwise have to bring to the table on day one. You can ask them to buy down your interest rate through mortgage points, which reduces your monthly payment for the life of the loan. You can ask for a home warranty. You can make your offer contingent on a full inspection and not feel embarrassed about requesting repairs. You can even ask for price reductions and actually get them. Practical takeaway: before you make any offer in today's market, research the listing history. Find out how many days it's been on the market. Find out if there have been previous price reductions. That information tells you everything about the seller's level of motivation and your level of negotiating power. Opportunity. 4. Rate buydowns and creative financing. Here's a strategy that sophisticated buyers are using right now that most people aren't even aware of. In markets where sellers are desperate to close deals, many are willing to fund what's called a 2-1 buydown. This is a financing structure where the seller essentially prepays a portion of your mortgage interest for the first 2 years. In year 1, your rate is 2% lower than your contract rate. In year 2, it's 1% lower. By year 3, you're at your full rate. For a buyer who expects rates to decline over the next couple of years, and who intends to refinance when they do, This structure dramatically reduces the out-of-pocket cost of homeownership during the initial ownership period. On a $500,000 loan at current rates, a 2-1 buy-down could save a buyer somewhere in the range of $12,000 to $18,000 in interest payments during those first 2 years. That is real money. Money that stays in your pocket instead of going to a lender. Practical takeaway. Ask your real estate agent specifically about seller-funded buy-downs in any negotiation. Not all sellers will agree, but in a soft market with motivated sellers, it is worth asking every single time. I'd be doing you a disservice if I only talked about opportunities without warning you about the traps. Trap number 1, catching a falling knife. In markets that are actively correcting, buying before the bottom is a painful experience. The challenge is that no one rings a bell at the bottom. Markets can feel like they've stabilized right before another leg down. If you're looking at a market that's down 15% from peak, ask yourself, is there a genuine catalyst for stabilization? Is job growth improving? Is population growth resuming? If the answers are no, you may be buying into continued weakness. Trap number 2, ignoring total ownership costs. The sticker price of a home is almost never the full story. Property taxes, insurance, HOA fees, maintenance, and utilities can add 2 to 4% of a home's value annually to your ownership costs. In states like Florida and California, where insurance has become a crisis, these carrying costs can be budget-destroying. Make sure you fully understand the total monthly cost of owning a specific property before you fall in love with it. Trap number 3, overestimating rental income potential. If you're buying an investment property, be conservative with your rental income projections. Markets that were delivering strong short-term rental yields during the pandemic boom have seen that income drop sharply as supply of short-term rentals has surged and tourism demand has normalized. Model your investment based on long-term rental rates, not optimistic short-term projections. And always stress test your numbers assuming a vacancy period of at least 1 month per year. Here's the bottom line. The American real estate market in 2026 is not a market of despair. It is a market of differentiation. The people who win are the ones who understand the specific dynamics of specific markets, who negotiate from a position of knowledge and patience, and who make decisions based on fundamentals rather than fear or hype. The homebuyer who panics because prices are falling misses the opportunity. The investor who chases yesterday's hot market buys someone else's problem. But the buyer who does their homework, moves deliberately, and takes advantage of a negotiating environment that hasn't existed in years, that person builds real long-term wealth. The market has shifted. The question is whether you're going to shift with it or get left behind. If this video gave you value, subscribe to the channel because we break down real estate data like this every single week. Drop a comment below telling me which market you're watching right now, or which city you think represents the best opportunity for buyers in 2026. I read every comment. Share this with someone who's thinking about buying or selling this year. It might be the most important thing you send them. Until next time, protect your money, do your homework, and don't let anyone rush you into a decision this big.